Greetings, market rebels. Welcome to this week's macro measure. It is Sunday, June 11th, 2023, about 11 a.m. here on the East Coast. I'm Wayne. My partner Ryan's, I think, on a flight back from Sonoma, where we had our live event over the past few days. So hopefully he's having a good flight home. Let's get things going. We will flash our trusty disclaimer, and then we will flash our trusty intellectual property rights notice, as we always do. And then I'm going to flash the summary, which is unfortunately a little bit smaller in terms of the font. But, you know, this market's been super interesting, remains super interesting. I think we have to take that into account and do the best we can to cover important things. Can't cover it all. I'm just starting because if I don't start with all the things I've got, all the notes and different things I've seen, Ryan and I've discussed, you know, we share a lot of information that goes into Market Outlook that Ryan puts together each weekend. And so bottom line, yeah, there's just so much going on. So we're doing the best we can, but, you know, we got to clip it somewhere. So here we are clipping it. So yeah, hopefully you can pause, take a screenshot to follow along. I'm going to do what I usually do at this point, which is to stop the share briefly, and then we'll switch out of this and we'll get the charts up at least while I talk. So let me get something up here, and that would be good. Let's see if it lets me just shut down I don't want the PowerPoint in my way any way at all. So let me get the share going again on a different screen. So here's the share. Let me get the PowerPoint moved over somewhere so I can see it. And then let's see, we should be able to finally discuss things. So this is one thing I want to cover while we're here. Let me just double check and make sure we're getting the right screen that's being shared. And I think we are, but you just never know. Yeah, we are. Okay, we're on the right screen. So let me maximize this. So this is one of the things I'm going to talk about. Since we land on it, let's talk about it now. And right now, you could see that last week, before kind of the different week close that we had, this has gotten up there, right? The percentage of stocks above their 20-day moving average, it's not at the extreme. We could be at a super extreme situation with a positive development this upcoming week on the Fed news. You just never know. So I can note that right now, that I can see, if you want to watch this whole video, I think there's a lot of interesting information that's worth, I guess, familiarizing yourself with or being aware of. But the reality for the upcoming week is that, in my opinion, humble opinion, it's hard to predict what happens with these Fed outcomes and the reactions. It's very hard to predict. So, I can make a case in both ways, and that's why I think the smart move is trade as best as you can in front of it. If you don't have a very strong opinion on not what the Fed will do, but what the reaction to what the Fed does or doesn't do, or does say or doesn't say, then you should just kind of neutralize, right, or reduce your risk at the very least. So anyway, just wanted to get that out of the way up front. But this has gotten a little bit, you can tell, right, if we give it a little bit more time. We did back off because last week didn't end the way prior weeks did, but you did kind of get up there. There's no doubt, right? So a lot of the rallies we've seen, it's gotten into this overbought area, and then there's been a correction that followed. So that's kind of I think the hint as to what's going on. The other thing is that, right, we can take a look at above the 50, and again, the 50 is pretty much up there. It's made a big move. But certainly, right, even just in the past few years, we've seen many higher readings. So on this view, it sort of starts to get you a little concerned, but you have to acknowledge that, hey, this could still go, right? And it won't be crazy if it goes. It could still go. And then following, the final one would be your 200 that we check on. And that, of course, can get much higher. And so that's not all that special right now. So again, that's telling you, I think, that could really go. But that's also, we're obviously, right, more kind of a neutral situation right now. Now, another thing that we should probably share while we're here and take care of some of these tabs, and then we'll just kind of skip over those as we go through this week's stream in terms of our list and points to cover. But we can't skip over this, right? Kind of dovetailing with that action is this. We've got the extreme greed that's getting registered here. Again, I always note this, so I know it's broken record time, but this is probably not a perfect measure of everything, but at least it's something we can go on, right? That we've got to work with. And in some ways, right, it's not all that bad, right? And you can see that this is probably over the last year of time, this is really your second highest reading at this point. So can you get a little higher? Yes. Could you get even higher than this? Yes, you can. But I think this is why we have to really go to from DEFCON 4 to DEFCON 3 for sure this week, which I've noted. But that could escalate very quickly to 2 and then 1, depending on what happens in front of the Fed and then after the FOMC. In other words, if the gang really goes into super melt up in front of the Fed, abandons all remaining sobriety, should there be any, and they just they're hell bent on really producing this melt up phase with the sleeper scenario, which we'll talk about again if you can stay awake. But that's why this could happen really quickly. So I think you have to really be on guard. So you kind of got that sort of longer term overview there. We also have an interesting situation that developed finally here, where it's the optimism is now above average for the first time since February. So this really is, we've been saying how this negative outlook, right? The pessimism has been helping the gang move stocks up, because so many people seem to think that this doesn't make a lot of sense. And I'd be one of them, right? But we don't trade it that way, right? That's the whole thing. So this is interesting because these price changes and price improvements, this does really start to change sentiment. And so that's what we've been waiting on in terms of the sleeper scenario. And I've seen more and more Wall Street analysts, and I don't have all that in front of us, we'd be forever, but I have seen more and more of the big firm Wall Street analysts flipping around, because I think of market price action, mainly, even if they're not coming out and saying that now they're bullish. They're bullish on the year, and they're thinking this, 46, 4,800 on the SPX is what we're looking at. And I just find that to be, they're late to the party, right? If you were bearish to this point, you missed out on tremendous opportunities as an investor too, but certainly as a trader, right? I think you're up 40% in the Qs, if I'm not mistaken, from the October lows to the recent high that was made, I think this week or whatever the case may be. That's a lot of rally to miss out on, and that's why I would always say, right, regardless of your strongly held opinions, and maybe for good reasons, still have to trade the market in front of you. Look at what the charts are telling you. Be objective. Go with the momentum. Momentum's confirmed by academics, as if that should really validate everything the way those guys are at times. But it's a confirmed thing in investing and trading, and that's what we're here for in terms of most of our market rebellion. Directionally oriented services are based on trying to find momentum on the cheap and cutting to the chase. So the other thing, right, I've been saying this, that I think, and a lot of you already know that I'm just bearish economically. We certainly are not trading it that way. We're trading it according to the charts, and they've been we've really shifted not too long after the October lows, where we had to stop saying, well, hey, this is starting to get a little better, and maybe you're not fighting it as much, and let's give it the benefit of the doubt for now. It's had a pretty strong sell-off, and then here we are now, right? And that just shows you, if you are willing to just remain objective, segregate, right, cordon off your strong macro take, and keep it in place for your appreciation of the risks that are building and how you manage your position. That's the key thing to do, in my opinion, humble opinion, that with that kind of material, knowing, right, that these guys can produce. This rally is nothing that's never happened before. And right, this is something that has happened before, where you get these tremendous rallies inside of larger bear markets. And again, I'm not even saying that's the case. For all I know, this really is the dawn of a new bull market. I hope it is. I hope my concerns are unwarranted, and so on and so forth. It's better for all of us, right? If we're in a bull market and companies are doing well, they're hiring, and so on and so forth. I'd rather have that. It helps everyone's investment, nest eggs, all that kind of thing. But this is what I think the market's getting ahead of, right? I just think, look, 70% chance that you still go up. And, really, and we're talking about now 6 weeks, right? So you're either 0.25 basis points higher or even more. So the chances are that you're greatly right, that you're higher. It's 2/3 chance roughly versus 1/3 chance. So a lot of this whole thing we know it's been built on AI, the whole AI hype. And we also know that it's been built on this presumption that the Fed would sort of peter out with the rate increases and then surprisingly, right, start cutting and cutting strongly and consistently. Really, potentially some people had it in May, but certainly some people had it in June for sure. And right now, June they're still pricing June, or the probabilities are still that nothing happens in June. So I'm not sure, this is not a market where I have any expertise. I'm not sure there's any market where I have expertise, but the bottom line is that this is the way they are pricing it, right? The market itself is pricing it. So there's your probabilities. But yeah, to me, like this just doesn't bode well. That tells me that you've got to jump between, I put this in our slide, right? That there's about a 2-month jump or gap between meetings. So unless there's something horrible happening in the economy, right, or there's horrible developments in some way that come, why would the Fed do anything between July and September, right? That would be something that would be happening between meetings, something they don't do all that often. Most of the time, the meetings are where they make the rate adjustment increases or decreases. So there you have it. So basically, right, if we jumped up now by 0.25, then you'd be there for 3 months, 4 months. It depends on when they do it, if they do it. But that's right. You're going to be higher by that much in just for maybe a quarter or more. So I'm not so sure that's a great thing, and that certainly pushes back the rate decrease scenario from when the bulls had it priced in. While we're here, we may as well cover it all. I don't think there's anything on here. Nope, there's nothing on there. This is the one I found that I thought was interesting from this Willie Delwich, not sure. But this is kind of interesting because we've been talking about how the sentiment's been really bad, but I think the better price action is starting to pull people in, like we've been saying. And that's what our sleeper scenario really was built upon, right? That there'd be this sort of chase once things improve technically beyond a certain point. We'll talk about that. But you can see that this is the best that we've been since November of 21. And again, if you want to know, well, that means that these guys were getting really, psyched up about what was about to unfold in 22. And of course, we were on the opposite side of that and saying, like, I'd be super concerned and I'd learn how to play defense and I'd learn how to go long volatility, which is what we talked about at our year-end roundtable or whatnot cocktail hour that we held. And so it just shows you this gang can be out of step as well. So, and not that we're always right, of course, but the bottom line is that in this case, we were certainly right. But it's not too far in front of what became an awful year. This is where their exposure was. So just keep that in mind. So now that they're getting back in here and they're getting it back to this level, we could switch back over to the charts, and I will, but that's that. So we don't need to look at sectors for now. May as well just mention while we're here that sectors, it was nothing special. It was kind of a messy finish. That you had some things doing better, some things ran and they pulled back. I don't think there was anything special about Friday. It was the big thing that really changed on it was that we didn't have that really strong Friday finish. And I think, as I put in the notes, I think that makes sense, right? Just because a lot of people have done probably really well that were willing to embrace what's been happening in the market, which we try to do. And those people were probably thinking, well, you know what? Maybe what we should do is just be smart, right? We've got this Fed situation coming up, and that is the potential monkey wrench, right? If there's a monkey wrench that we know about in the near term, it's got to be this Fed meeting, the way I'm looking at it. Now, after that, of course, you'll we get through this, and you're probably about a month away from EPS season, so starting, in earnest. So that's probably the next big thing, unless there's geopolitical. But there can always be a geopolitical. But this is interesting. I left this up, so we'll talk about this while we're here due to attempting to save time. But this is interesting because this has become very popular in terms of discussion. This is the equal weighted S&P 500 as opposed to the market capitalization weighted, or whatever they've got in place, right? And this is certainly lagging behind the SPY. Let's put it that way. And that's become the big talk. And as we were noting, right, it was something that I don't think we charted a few weeks back. We were saying that they had to broaden this rally out, right? Because they took all their main driver stocks, their mega caps, and they went berserk in terms of goose mode with those. And so lo and behold, right, late that week, because we came into that week saying they had to do that, end of that week, they did it in a big way. And then they pushed it even further this week, where they're buying, more and more. Now, is it incredible, right? Is it on the verge of something incredible? I don't know. It could certainly break out further, right? If this rally still has legs to it, it could break out further. I'm still skeptical about this rally, though. I still feel as though there was almost like panic broadening, if that even makes sense, where it was like, oh no, everybody's pointing out that this advance is led by these mega caps, and it's one of the more narrow advances in history. And we did even flash things in videos. I don't recall when we did it in macro measure, but of course in Market Outlook, it's been there, where the top 7 stocks are responsible for all your gains, and AI is a big part of that. And so yeah, all those, and the AI thing really left the market behind. And to how much further can you push that? Well, they could keep pushing it, but let's face it, by some measures, it became extreme. And certainly those names were stretched in a big way against essentially their also ran peers or companions, right? They really got so far ahead. So the gang did try to address that a couple of weeks ago. I feel like they panicked their way in. Now, maybe that gets back to some of the mechanical buying we've talked about, where certain players, when certain conditions are in place, and CTAs are what people usually refer to for this, they just simply go with the mechanical condition, right? Those conditions are, everything's mechanical, and then they flip from bull to bear. So who knows, right? I don't have numbers on that to be able to say how much of that has contributed, but I do know that a lot of people will change their sentiment based on the price action. And that's, to me, like could be part of your investing process, but historically that really hasn't been right. The way that these guys really don't talk about, well, the technicals aren't great right now, and that's why we don't like the market. They only kind of really flip around as bulls, which we would expect, right? That, oh, well, things are acting well, the market's telling us this, so now we're going to add more long shares. Okay. Well, that's not really that you're not really telling me the economy or companies are going to perform better. You're just willing to chase things and at higher valuations because other people have. So whatever, that's how people want to operate. I'm not criticizing. I don't manage that equity type of money, and thank God I wouldn't want to. But I'm just saying I think it's sort of dubious. Let's put it that way. So having pontificated a little bit there, let's go through. I'll get the SPY up there. Let's go through our points here. So, yep, this is all rehashed, but early in the week was a little messy. We said that we thought it would be that way, right? That was the most likely scenario. And you had a little bit of early weakness here, and here's Monday, and then here's Tuesday, right? So they kind of did what we typically look for, which is pause or pullback. They even did it into Wednesday, right? So a lot of your early week was spent churning off that overboughtness. And then this is the 30-minute chart that I switched to. Sorry about that. Just wanted to make that clear. But bottom line is, right, that's when they finally put the rally together. Things looked good Friday for, I guess, early on, but that's where it ran out of steam. I think maybe like a little prudence may have seeped into things, given where the fact that the Fed is looming. So I do have another note, which is the VIX. So at this point, I just wanted to make a special mention of the VIX. This is something that we talk about in some services, but we certainly talk about it more so in Phoenix portfolio. So we mentioned a few weeks back that if they got beyond a certain point and everything was fine, then this scenario could play out where the VIX really gets itself smoked. And it did. You know what I mean? I again, this is not patting yourself on the back. I'm just saying I talk about scenarios that I think are most likely. I don't talk about things that I'm predicting, because predicting to me is not I talk about this a lot, but I don't like the idea that about predicting. To me, it's more about being objective and saying what's likely to happen and adapting. So that's my whole thing. But you've got to go back to levels maybe in 2020, maybe in 2021. I don't want to get too deep into it. Maybe it's still 2021, but you got to go back a ways to find a time where the VIX was this beaten down. Now, this is very interesting to me because I don't chart the VIX the way I do a normal equity or an equity ETF. I don't think you can do that. It's kind of, cycles and mean reverts and so on and so forth. But this is now, to me, very interesting. This, to me, seems to be underpriced. And unfortunately, I wish I had time for this type of stuff, but there's a gentleman named Barry who deserves full credit for this, because he had pointed out that late on Friday, he asked me what my opinion was in Rebel Pit with respect to a strangle. And let's see if we can get that strangle to show. And I said, well, let me take a look. And I took a look and said, my gosh, right? That's incredible, really. So if you look at this, right, here's the 428 put, here's the 432 call. So you have to look at that and say, these strikes are not even, right? A 0.5% away, given the price. They're just about 0.5% away on either side. Now, granted, you've got to move a full percent beyond one of them. You've got to move beyond those to really get the long strangle to pay off in a big way, unless volatility jumps, which it could maybe. But he managed to leg into this for just a little bit over $3, $3 and change, which I think was an excellent trade and observation by him, because I'm looking at this as, well, you're able to buy dirt cheap. And we all know that if anything can move the market in some big way, it could be an FOMC surprise in one way or the other. So to me, this thing could still go. And this is why you just can't really forecast, because you have no idea what they're about to do or say. And if they say, well, you know what, some recent data, we were leaning towards an increase, but recent data has come in that we're going to pause. And, in fact, we're even leaning towards, whatever, maybe being a little bit more of a pause or a pull back on our rates, excuse me, and maybe going forward from here. That could really be the final sort of euphoric melt up phase of this rally. And so that's certainly possible. On the flip side, right, we just had what I would call a fake out or a false breakout attempt where you didn't keep going, right? That's really not, when you start taking out the highest recovery high since the October lows in this market, you get up to our sleeper scenario level, and then you fade. Not that that's super uncommon. It's just that you can't be thrilled about that. Like, if there were not an FOMC meeting looming, I'd be ready to counter trend trade this a little more than I usually do. And I just don't like counter trend trading. So that just tells you, I'd really be ready for this to put a pullback in. I think a lot of us know that a pullback is due, right? That's almost a problem, because a lot of people realize what we do, which is that things became overbought, things are frothy. Are they extreme? No, but they're certainly there, in my opinion, in general, right? In a general way. And you're getting stretched from certain things. So that's my issue. But how to do what Barry did and pick up something where if you can just get a little bit beyond one of those, you could possibly do very well, given the kind of reaction that could come in. I thought that was a nice little thing that he did there, and great observation by him. he's getting it cheap. And he said he looked at the Qs and maybe IWM or the diamonds, I can't recall, and that was far more expensive. So that's an excellent job by him. So he legged into it, obviously, to get those prices. So I just wanted to mention that. So let's cover everything. We'll make sure we're covering things properly. I think we covered the first couple things. We had different kinds of weeks. So let me cover the different kinds of weeks comment. Similar but different, right? In terms of, like, let's just jump over to the diamonds. We'll get to the Qs, of course. But, the diamonds did a little bit better in terms of that final candle. I think probably, right, could be due to some of their weights, right? There's only 30 stocks in there. There a couple of them could have done really well and held up, but that finished a little bit better in terms of, it seems like there was a rotation. They kind of held on to a new closing high relative to near prior ones. So we'll see, but it's getting up there towards the top end of its trading range. Let's see if I can get this to flash over here. So I need more computers and more screens. That's what I really need. But you finished at about 70 on the 2 hour, right? So just to kind of keep that in mind on that one, where that's maybe, again, you're kind of getting overdone. Let me just flash a number before we move on to the Qs that everyone kind of finished here on the 2 hour, half day, 4 hour, all near 69. So again, you're getting there, right? Probably wouldn't be crazy. Again, we've been saying this now, it seems like for a month or so, or maybe even longer, that a lot of the times during this year, that's for sure, maybe things are a little overdone and they need to pull back a little bit in front of the Fed. We'll see, though. I mean, you just have no idea. Not really, right? There's a lot of indecisiveness right there on this candle, right? You make a new high, you don't even close above the former high closes. So that's, to me, that's not the way you want to do this if you're a bull, and you are stretched for sure, but is there more room before you become really, really overstretched? And I still would say there is. You have to admit that. The Bollinger Bands up there are only, I knew I might have left these on. Those are, no, let me check that. I knew I may have left that there. So let me just get that cleared up. Apply. So there it is on two. Ooh, we switched over to percent. There it is on 2 standard deviations away from the 100 SMA mean or spine or whatever you want to call it. So it is still stretched that way. But again, these guys are holding it above the recent low. These guys are holding it above the 10 SMA there in white. And we've seen stretch get far worse than this in different things. Now, it's not common for the stretch to get so big in an index like this, but remember, it certainly can, and I wouldn't rule that out. Although you have to admit, with the gaps that they've left, the fact that they've made so many things overbought and overstretched, there's vulnerability too. I mean, it's a very, when you throw in the fact that the Fed it could say anything, do anything, or both, you really have a hard time seeing past there with your crystal ball and saying, yeah, this is likely to happen. I mean, the recipe's there for melt up, in my opinion. The recipe's also there for a major pullback of not just 1%, something more. Maybe you have to go down to, excuse me, maybe you drop down to the 20, which would be a 3 or 4% pullback. And you kind of where you come in near the 20, and you come in at a trend line with some support, something like this. Let me get this. Just bear with me. Put a less than perfect line up here, but maybe you get something. I didn't like that. I'm going to try to get this to fit. Maybe it's something like that, right? You come into there, which maybe the 20 levels off by then, whatever. But maybe you come into the 340s. Maybe you don't close this. Tough to say, right? I just think with a meeting there, you can't really get to pound the table-ish in front of that. Very tough. So uninspired finish. Let's talk about that. Let's talk about IWM, and then we'll talk about the SPY sleeper scenario again. And this, to me, is why it was different, right? That you got in the IWM, they did have this was an amazing ramp job. I watched it happen. I'm like, wow, that's really powerful action that was unfolding there. Got above all the SMAs, And but by the end of the week, though, they had backed it off from really being super overbought, right? It was at 187. They did bring it all the way down to 184, which, not quite 2%, but they backed it off 1.5% perhaps there. And that helps on the overbought, oversold readings. This still has plenty of room to go to catch up. It's lagging behind the others, the SPY and the Qs dramatically. You could see that even this high, right, it's well below there still. So that could also tack on more. Again, I would not get in the way of it just yet. I would trade whatever you can nimbly in front of the Fed and then see what happens. And then maybe we re-engage with the market in a bigger way after the Fed. But yeah, so the sleeper scenario, let's cover that with that melt up. Basically, I've been arguing that there's a possibility for this because I've seen it happen so many times over the years. And it's nothing extraordinary. It's not like, wow, what a revelation. Let me see if I can get this. But it's just something that I started latching onto because I've seen it so many times. And that is this high here was part of the bear market downtrend. And it was a big high. Clearly, right, the market really put in that final leg on the way down from that high. That's where it failed to keep going and reverse. And you ended up, that led to your bottoming process. And what I've noticed, just again, having done this for such a long time, I'm sure other people have, and so it's not like I'm trying to claim anything great here, but this is a very obvious high, and this is a high that would be, you would say, well, if you get through there, you're taking out the bear market highs and you're closing above there. It's not just that you're advancing beyond highs that were made in your recovery. You're actually now really starting to take out key highs that formed in the bear market. And I think that's people seeing this high, these highs get taken out. That caused this kind of capitulatory phase here that they pulled the rug on. Now this high has gotten taken, these highs have gotten taken out here. And that could also cause a capitulatory phase. But I think the way to really kind of cement this bull market-esque run that we've seen is that you close above here, which they didn't do. They did put a new high in versus there. They weren't able to hold it. The action was kind of lackluster, in my opinion, because I've been waiting for this to happen for such a long time. I watch things pretty closely around all the other things that I normally do. I don't always have the time or make the time to watch what's going on, but we didn't spend a ton of time above the bear market downtrend low. I mean, high made on that day, it was 431.73. So you barely eclipsed it. I didn't see a lot of, probably there were some short-term traders that got ran out in terms of stops that they set too tightly, but it didn't seem like there was a big rush to buy the market, obviously, at that point. And that makes sense because, right, people have probably bought that are true believers. And again, have changed like how much money really has moved into this market. They probably already bought somewhere in here, right, during this recovery. So a lot of them were probably like, I'm going to wait. And they also noticed, right, how overbought things were at that point in time. So, we closed off of there, but we were definitely at a higher overbought reading at that point. Even now with the back off from there, the SPYs are at 69, right? So roughly speaking, if I round it off. So I think that kept people out. I think the FOMC kept people out, but who knows, right? Maybe there's going to throw caution to the wind and they're going to jump in here in front of the Fed, or they're going to use whatever the Fed has to say to create this possible scamper that puts it up near I've been ballparking it at around 440. In other words, another 1 or 2%, who knows, maybe more, but another 1 or 2% gets tacked on. And that really starts convincing that's the result of people piling in saying, well, they're taking out bear market downtrend highs. And that to me will be a possible capitulatory situation where people finally cry uncle. And then you might get, which I think you're set up for, honestly, the second half of June into July, kind of rough stuff. Could be just one scenario, right? Doesn't have to happen, but we've been watching that for a long time. That's the logic behind it in a back of a baseball card type of way. So don't want to go into this, but right, the presidential cycle is still preserved to this point. Remember, we are in the sweet spot on that. heading into really middle of July. So that's it is what it is. The Fed tool, we showed how the Fed watch tool shifted to a 70% probability that rates are higher by 0.25 basis points or more by the late July meeting. June, however, has been rough for the mega caps that had performed. We've shown that previously, but remember, that is the case. They've had a great run. They've gotten overdone. So remember, right, the Fed is a possible, I guess, fulcrum or flashpoint for that, where suddenly things could change, and you do finally get the pullback that probably too many of us are thinking is due. The Fed surprise. So the Fed surprise is there. I did note that the advance did broaden, but again, finished weekly. I still think a lot of this is too far too fast. And that brings up my chance to show all the colored dots that everybody knows and doesn't really love, but I always forget where I'm at on those. Let's see if I can guess right for it. Nope, bad guess. If I were on one of those game shows, I would never make it. My guesses are terrible, even about my own charts, where I've got things positioned. I wish there was a way to identify it. You could say, well, geez, you're running too many different views, but this stuff I find to be very helpful, despite all the claims that people make that all you really need is price action. I'm on the other side of that. I think that charts can be used. There it is. Yeah, charts can be used to save you time. You could study price action, but if you haven't looked at something in a while, you need to make a quick assessment. It's hard to beat well constructed chart layouts for that, in my opinion. But anyway, that's a whole nother issue. Here's the XLK. I just wanted to show everyone, right? If we go back, and we are going back a ways, remember, we think we did this last week. I'm pretty sure we did. But if we go, this is a 10-year actually. So I want to show everyone that the percentage of the XLK that it expanded or stretched above its 200 SMA. Remember, that's the technology ETF. You have these are the past 10 years. Now, really, right, the only ones that really beat this are the kind of absurd mania in front of the COVID fallout. Ryan and I were waiting for this COVID to finally kick in, and just amazed at the fact that these guys were acting so oblivious to it. And given all the news that was developing and and technical vulnerabilities, but you almost got back to there. That was an extreme. But the only real one that gets far worse is the post-COVID response, when the powers that be injected $7 to $10 trillion. A lot of it made its way into the stock market, with people becoming traders because they were forced to be at home or lost their jobs or whatever. And so that was even more stretched. I don't know if there's another $7 or $10 trillion on the way. And I guess due to inflation, it wouldn't have the same impact. I don't know if that's only worth billions now with what they've done over the past few years. But regardless, this is still very stretched. And other than really the COVID response, you can't really find stuff that's all that much higher, right? So you're rarefied at this point. That's where you are. You're in the rarefied. And I think you've got to keep your mind on that, to know that this is maybe still money to be made as a bull. We're going to trade it if the charts are holding up, but you have to, you got to go to, I think you got to go to DEFCON 3 here, right? With all the stuff that's turning up. And remember, the NVIDIA, you'll see this. Now look at this, right? Because this is your percent stretch. There's all these years, and I don't think we have to go all the way back to, and that's not even that high. So this is this recent NVIDIA stretch from the 200 SMA in red. That was the highest one over the past 10 years. And so I don't act as though this is all my own, I'm the original thinker on this, so I don't want anyone to take it that way. But I'm looking at it and saying, this has gotten ahead of itself, right? They've really, really gotten ahead of themselves. I think they're pricing in and pulling forward, things. In other words, all this great news is being pulled forward. They're super stretching a lot of things, like we just saw. Their value. This is all based on valuations going up. right? It's not really based on anything else. Most of this is based on them just pushing up stock valuations, not really the S&P 500 12-month forward earnings expectations rising. So they right in the midst of all this, they've annihilated the VIX, and the put call ratio, as we saw last week, was it crushed as well, right? So there's a lot of complacency out there. That's the other factor. So in a way, it's very interesting because, right, you really finally had to switch to optimism after too much pessimism, but there's already complacency in place, even though the switch to optimism is so fresh. So we know that now that the active managers have possibly gotten themselves trapped if there's a big reversal coming. They're the longest they've been in 1.5 years in terms of equities right now. We talked about that. I still don't see this. I feel like this is panic buying where everyone thinks I better buy because other people are buying, which I guess you could say is FOMO, or maybe they're worried about underperformance. Whatever the case may be, I think they're just rushing in and pricing a perfect scenario going forward. I think, as I noted, I think it's really not about the 12-month forward EPS expectations so much as it is just buying on hype and buying on momentum. So I think that's a strange way to discount things, if you ask me. It's when you get to extremes to keep buying. But again, there's everything, I guess, works at certain times and places. I just think that the price improvements are causing the sentiment to improve, and so more people are just jumping in. That's what we've talked about in terms of sleeper scenario virtually all year long, that would force people to start doing that. Maybe they just started to do that in a bigger way. Of course, I don't have the best current data on that. So I don't see that as really investing. To me, like, you might say, well, I have a technical component to what I do as an investor. That's fine. But traditionally, all these big money managers have not really, acted that way in terms of, well, the technicals are telling me this. Like they tend to use the technicals only when it helps support their case, right? They kind of ignore them when they don't. But whatever. Again, that's an aside. So yeah, I think other factors on this jam job are buybacks. There's gamma squeezes still going on, despite that sort of flip to optimism. There's still, I think, a lot of sentiment out there. That's me, kind of just my own observations with reading different things. I still think a lot of people are underinvested. I think the FOMO crowd will get drawn in even more, as will the YOLO crowd. I think there's mechanical buying going on due to what they've been able to do to this market. I do see squeeze targeting again, which they've come after these rinky-dink names that have high short data factors. And I could see where then panic buying ensues, or even momentum players jump in on that. So the bottom line I'm going to start to end things with is the market continues to ignore the data that's concerning to me. I still think Europe and Asia are not looking all that stellar. Latest I saw out of Germany, not good, and Germany's critical in European economy. I still think you're overbought in many ways, but you're not. In some ways, though, they back some things off from extremes. There's no way around the FOMC forecast for us. There will be games played, right? They play games every time. There's all kinds of shenanigans that go on before, during, after. Be prepared for that. Anything could happen. That's why, I think if you want to have a 50-50 bet, that's always there for you, right? So you can do whatever you want that way. But I think sidestepping that, if you're not really holding strong convictions, is the way to go. As we continue to note, right, we're just going to keep focusing on the price action. And the note is that this SPY sleeper scenario failed on the first attempt. Again, not uncommon for that to happen. And again, given the run that it had and how overbought it was at the highs, that kind of makes sense that it wouldn't be able to push through in most cases the first time around. You could see the SPY is a little stretched. So this could end up being a false breakout where you take out a lot of these highs in this kind of price channel you were sort of in for a while, and then you revert back down, possibly. We'll see. I do still think we just have to go with the flow. We'll probably get hopefully a couple decent days in on Monday and Tuesday. I think, after the morning, you just wind it down on Wednesday. You see what they do. If things start to unfold, you get in, get back in a bigger way. And then certainly Thursday and Friday could be interesting as well. But, that's going to be the tough part of this week. I do think things are toasty. I do think that you got to go to DEFCON 3 at this point, because if the Fed doesn't sing the right tune, you could escalate from DEFCON 3 to DEFCON 2 to DEFCON 1 very quickly. And I still don't see any surprising out of nowhere bullish drivers that have appeared. The stuff that I've followed over the years continues to say that we not only don't have a soft landing, but we probably have a hard landing. So again, that stuff could be wrong. It's not like it's got a perfect track record, but that's the stuff that I followed, just doesn't see what all these people see that are piling into stocks. And remember, there's that 2-month gap. So I do think, right, kind of in summary, to kind of wrap things up, I do think that you have a situation where you are set up for significant corrective activity as a possibility, right, given how far all this stuff has ran to this point. I do think you could really be in for that. I'm not predicting that, but you just have to acknowledge that's the current conditions and they lend themselves to that. But, right, we know we're in a wild market at times to the upside that's not being driven by, I don't think, rational thinking about the future. It's a lot of it's been based on hype and other things we've discussed. And that could also continue, right? You can't say that it can't, because if you traded through the late 90s into 2000, you know that it can become even beyond take your breath away extraordinary with some of the moves that got made back in those days. So you just can't rule these things out. So I think the smart play is, right, if you're going to have a corrective activity before you get to earnings, which shouldn't be a shocker, it makes sense for that to start relatively soon, have a 2 to 3 week kind of maybe listless action, maybe pullback action, maybe severe. And then maybe when they start working their way towards the start of earnings season with their optimism that they always seem to bring to it, they'll start working stocks back up into it, saying, oh, maybe we can get a positive reaction because earnings will beat. And remember, I'm the guy that always points out that 75% of earnings beat with great consistency over time, which tells you how they rig, right? They rig things, because if only 50% roughly beat, then you would say, well, the analysts on the consensus analyst forecast is reliable and a real thing. But we all know that they sandbag it so that they can celebrate how wonderful a company just did. I've seen everything spun over the years where just absolutely miserable things were being taken as wonderful. And that initial reaction in the stock is also wonderful. You go look back on it, probably 6 months later, you were dead on right to say it was a complete joke. But, right, do you really want to get smoked in the short term? I would just look elsewhere. No, I don't. So I know earnings trading and that stuff works for some people. It's just not for me. I think a lot of other things, for the way I do things, are much more bankable than earnings trading. I think pre-earnings runs, for example, are more bankable than the speculating on the earnings reaction. But again, I'm not an expert on anything, certainly not earnings plays. I just never really had that great success with them after a while because they became almost more like a spectator sport, largely thanks to CNBC and the way they cover things. So it became like, oh, earnings season, it's almost like March Madness to them. But anyway, that's that. So I do think you've got to be careful here. The SPY and some of these things on the weekly are also getting up there, and we don't look at all the charts. We don't have time to look at all the charts. This could go on for 8 hours. But if you look at the weekly, for example, I'll just flash it. The weekly RSI is 72 on the Qs. So that's not a joke when a larger time frame gets to 72. Does it mean it's over? Of course not. But you got to be careful. They managed to get it to this retracement. The next one up is far higher too, right? So if they go to an even greater retracement from the high to the low and back again. So that chart is hard to argue with. It's hard to dislike something that's been trending that strongly, but I would just caution that it depends on, this RSI's got a little bit of a different time setting. I'm flashing in the lower left-hand corner, but that's at 74. And that's even after kind of like a week that kind of stalled out. So it just gives you an idea where it could be. So I think that's kind of toasty. And I think you've got to respect that. And so I pretty much need to end it probably on this so that we can get sector situation done and move on. But the final comments are, yes, be careful, be nimble. You want to speculate, that's your own business, but I don't like the FOMC reaction. I can't stand FOMC weeks. I really prefer once we get beyond that, since we get back to kind of like, I think, more predictable trading rather than what could happen there with that big wild card monkey wrench. So hopefully something to share with you in this video helps you out this week or some week in the future. And I do want to thank everyone for tuning in. Thanks again.